Hello guys, my name is Abhinav Garg and today I am here to explain about the topic decision tools, or you can say CVP analysis. Let me share my screen so that I can share you the PPT that I prepared. So as you can see, yeah, decision tools, or you can say the CVP analysis. The CVP analysis is cost volume profit analysis, is the study of effects that changes in cost and volume have on a company profit. It is important in profit planning. Like whenever company wants to introduce a new product or they want to change the selling price, they first of all do the CVP analysis. Now the CVP income statement, like you can see, first of all we see the sales, and then we deduct the variable cost, we get the contribution margin, and then we deduct the fixed cost, and then we arrive at operating income or losses. Okay. Now we have to discuss about the variable cost, that is the cost that changes as the quantity of product changes. Like per unit variable cost is also used in CVP analysis to deduct from sales per unit to arrive at contribution margin per unit. So you can see unit selling price minus unit variable cost equal to contribution margin per unit. Like we have a selling price of $500 and variable cost is $300. So contribution margin per unit is $200. It's very easy to find. Now let's talk about the contribution margin because it is a very important concept in CVP analysis. Contribution margin is the amount remains after deducting variable expense from sales revenue. As you can see from the previous example, like unit selling price minus unit variable cost equal to unit contribution margin. So contribution margin can be found in two parts, like per unit or ratio. So per unit, unit selling price minus unit variable cost equal to unit contribution margin, and contribution margin ratio can be found like per unit contribution margin divided by unit selling price. Like you can see contribution margin per unit is $200 and we are dividing it by selling price $500. That is contribution margin ratio is 40%. So it's quite easy. Like if you know the formula, you can easily calculate the contribution margin per unit and ratio. Now the next concept is break-even analysis. At this level of sales, the company will realize no income and will suffer no loss. Okay, so if we are at the break-even situation, we don't even earn a profit and we don't even occur a loss. So break-even point can be expressed in either the sales volume or say dollars. Break-even point can also be can always be found in units or dollars. Okay. Now the next point is margin of safety. Uh, Let me give you the example so that you can understand the margin of safety quite easily. Like the company is actually selling 7,500 units per month, and while calculating the break-even point in units, they found that 5,000 units is the break-even point where they are earning no profit, no loss. So the difference between the actual sales and the break-even sales is 2,500 units. That is the margin of safety. Like company sales can reduce by 2,500 units, still they will be in the position of no profit, no loss. But if the company sales goes below 2,500 units and then the actual sales, then they will suffer loss. As you can see, I have given the figures. Like actual sales is $750,000 minus break-even sales is $5 lakh. That is margin of safety in dollars is $2,50,000. Like we can say that 2,500 units is the maximum limit that company can fall. Okay, so the next point is required sales, and we can find it in units and dollars. Required sales in units is fixed cost. If you have to find required sales in units, then the formula is fixed cost plus target operating income divided by contribution margin per unit. And there's just little difference in calculating required sales in dollars, that is fixed cost plus target operating income divided by contribution margin ratio. If you are finding required sales in units, then we will divide fixed cost plus operating income by contribution margin unit. And if we are finding required sales in dollars, then fixed cost plus target operating income divided by contribution margin ratio. So let's quickly move to our question so that you can understand it clearly. Yeah. Let me show you the screen again. Yeah, this is our question. Yeah, see, this is the question from Amazon.com. They have given us the various figures. Now let's simply just concentrate on the figures. Like variable cost is given. Direct labor per keyboard is $8. Direct material per keyboard is $4. Variable overhead per keyboard is $3. So the total variable cost per keyboard is $15. Now just write it or keep in mind that $15 per unit is our variable cost. Now let's see the fixed cost. Manufacturing is 25,000, selling is $40,000, administrative is $70,000. So total fixed cost is $1,35,000. And selling price per keyboard is given also like $25, and the last year company has sold around 20,000 keyboards. So the total sale is 5 lakhs. Now we have all the figures like net sales $5 lakh, sales per keyboard is $25. My fixed cost is $1,35,000, and variable cost is $15. Now it's quite easy to find each and every question. So the very first question is, what is the operating income for 2022? It's quite easy. As you have earlier seen my income statement, we will simply take the sales, that is $5 lakhs. Then we will less variable cost, that is 20,000 keyboards into my $15 is 3 lakhs. Contribution margin is 2 lakhs. Fixed cost is 1,35,000, and there we go. The operating income is $65,000. It's so easy to find if we have all the statements with us, like variable cost per unit, sales per unit, fixed cost. Okay. Now the next question is, we have to find the unit contribution margin. It's very easy. Unit selling price minus my unit variable cost equal to unit contribution margin. That is, unit selling price is $25. Unit variable cost is $15. So unit contribution margin is $10. It's quite easy. Next question is break-even point in sales. Break-even point in sales units. You know, break-even point can be found in units or dollars. Now we have to find it in units, so it's easy. Just take the fixed cost and divide it by contribution margin unit. As we have the fixed cost of $1,35,000 and contribution margin per unit is $10, so 13,500 units is the break-even point. Like if the company sells around 13,500 units, they will be in the position of no profit, no loss. Okay. So the next question is, it's quite important to understand as we read. Assume that management has set the target profit for the new year is $5,50,000. And for this, the company has put the additional selling expenses of $10,000. And what will be the break-even point in sales dollars for 2023? If we just have to find the break-even point in dollars. If company wants, as company have increased the advertisement expenses by $10,000. So it's quite easy. As you know, the break-even point in dollars is fixed cost divided by contribution margin ratio. That is, fixed cost is firstly we will have to find the revised fixed cost because advertisement expenses has increased by $10,000. So here we go. Current mix cost, fixed cost equal to $1,35,000. Additional advertising expense is $10,000. So revised fixed cost is $1,45,000. And we require the contribution margin ratio equal unit contribution margin. To find the contribution margin ratio, we have to take unit contribution margin and divide it by unit selling price. That is $10 upon my $25. That is 2 by 5 into my 100, 40%. So now we can easily, oh, where it went, let me see. Oh, yeah, this is the question. Wait a minute. Yeah, as we know that the new fixed cost is $1,45,000 and contribution margin ratio is 40%. So break even point in dollars is $1,45,000 divided by 40% is 3,62,500. As you see, it's so easy to find. Let's see the fixed question. If the company spends the additional $10,000 for advertisement and unit cost remains same, so what is the sales level in dollars required Now the question wants that to attain the same operating income of the last year, that is $65,000, as company has increased the advertising expenses of $10,000. So how much sales in dollars we have to do so that we will arrive at the same operating profit that we have got in the last year? So the required sales formula is fixed cost plus target operating income, that is $65,000, divided by contribution margin ratio. Now we also know that contribution margin ratio is 40%, fixed cost is $1,45,000, and target operating profit is $65,000 because it is the same operating income that we got in the last year. So $1,45,000 plus $65,000, that is, you can calculate $2,10,000 divided by 40%, that is $5,25,000. So the required sales in dollars is $5,25,000 to attain a target profit of $65,000. So that's the question. And anyone, if you have any doubt, you can ask in the chat box and I will reply.